Welcome to the monthly roundup from Kepler Trust Intelligence, brought to you in association with Schroders. Join me, Ryan and David as we discuss the most interesting news and hot topics for investors from the last month.
And in this month's edition, David finds out why AIE's Ayush Abhijit thinks India has performed poorly recently, but why he's also optimistic about the future.
Jo will talk us through the highlights of her Market Matters podcast with Olivia Markham from BlackRock World Mining, as well as BRWM's latest results, with a quick canter through the stat of the month as well.
But first, Ryan will run through the news, including an update on the ongoing Saba saga, although not before some information on manager changes.
Quite right, Jo. We begin with the news of the management team behind three of the industry's best performing near-term trusts. The trusts in question are Golden Prospects Precious Metals, or GPM, Geiger Counter, or GCL, and CQS Natural Resources Growth and Income, or CYN, with managers Keith Watson and Robert Crayford having resigned from their roles at CQS, a subsidiary of Canadian firm Manulife.
And these trusts have had some strong performance too, so what steps have been taken here?
Indeed, all three trusts had quite stellar returns over the past year or so, ranging from around 90% to 130% NAV total return, with arguably plenty to support this going forward. In the interim, the boards have served notice on two of the trusts, and one says that they are considering their options, although it should be noted that the managers do have a notice period at the firm themselves.
And any word on where the managers might end up and what might happen to the trusts?
There has, in fact. They will be joining Tufton Investment Management, which in our investment trust space is most well known for running the Tufton Assets Investment Company that owns a portfolio of commercial vessels, aptly titled SHIP. The board of one of the original trusts has said that they've received a proposal from Tufton, so it seems that one very viable possibility is that the board of each of those three trusts follow the managers to their new shop, although other alternatives are of course possible. Either way, plenty to watch out for in this evolving situation.
Yeah, one to keep an eye on there. And elsewhere, we've seen some fee cuts in some popular global trusts, have we?
Precisely, yeah. We'll start with the giant that is Alliance Witan, which has reduced its fees to a flat rate of 0.46% of market cap from the beginning of the month, with a further 5 basis points to come off of that, so going down to 0.41% at the beginning of next year.
How does that compare to what they were before?
Well, previously, ALW, which is the ticker for the trust, had a tiered structure, which, depending on the level of assets, average out to sort of just over 51 basis points. So fees are down around sort of 10%. They remain calculated on market cap too, meaning the managers remain incentivized to narrow the discounts, which is around 5% at time of recording.
And am I right in thinking that's not the only fee cut we've seen this month?
Yeah, quite right. STS Global Income Growth, managed by James Harries and Thomas Boniak, also saw its fees cut. The trust is actually in the global equity income sector, so more of a cousin to ALW rather than a direct peer, although it doesn't quite benefit from the same economies of scale as the giant that ALW does. Regardless, they've cut management fees also to a flat rate of 0.4% of net assets, below their previous tiers of 0.5 and 0.55. As such, fees are expected to drop around 20%, which we think is actually a really good result for shareholders and makes STS a very competitively priced trust in our view.
Now, I'm not sure we could get through our news section without any mention of Saba, so what's been happening this month?
Yeah, sort of quite a lot and also not very much at the same time. As we alluded to in our previous month's edition, we noted a couple of trusts were approaching something of an endgame with critical votes coming up. Now, one of these was Edinburgh Worldwide, managed by Baillie Gifford, which is going through a final tender offer, which will effectively close the trust, albeit allowing for a potential realisation event of SpaceX. Although, as we know from the Saba saga, there are sort of views and counter views as to whether this is actually going ahead. It's an AGM coming up, who will report it the next month. Similarly, Impax Environmental Markets, or IEM, looks to be moving towards an endpoint also after the board failed to find an agreement with Saba and is now progressing towards an exit tender offer.
Now we know Saba are never shy about coming forward and putting their views on record. What's their response to all of this been?
Yeah, well, as you expect, quite a lot of claims and counterclaims, but either way, we think the lead manager, Boaz Weinstein, is hardly fulfilling his saviour role that he claimed he was when he first arrived on the scene, having now effectively shut down two trusts. However, considering the firm has recently launched an ETF focused on the investment trust sector, we don't expect these issues to go away anytime soon.
Which I guess will give us some more content for the news next time.
There is that, although it may seem just repetitive on occasion.
So moving on, it's now time for results. Ryan, we're going to stick with you for the results of Schroder Asian Total Return.
Yes, very happily moving on to the results now. Yeah, Asia Total Return, or ATR, to give it its ticker, published its annual results to the end of 2025. The managers delivered yet another year of double-digit returns with 14% NAV total return and an even more impressive share price return of just over 19%, perhaps reflecting increased appetite for the managers' strategy, which aims to mitigate some of the short-term risks in markets, as well as capturing the long-term growth potential of the Asia-Pacific asset class. Now, we should note that the Asian index, which isn't a benchmark as they are agnostic to it, but is sort of it is a reference, that returned 20.6%, just for context.
And what does their positioning look like?
Well, this is usually the most interesting part of the ATR results, considering they use both top-down and bottom-up inputs. You get sort of a bit of macro input as well as that stock selection process. The managers have been reducing their exposure going into the end of the year, and were adding to more defensive markets. So they took some profits out of the more higher valued parts of the market. They had quite a few stocks in technology, etc. So they've clipped some profits there and then sort of pragmatically repositioned into the more defensive markets around sort of Singapore and Australia. So it's interesting to see their macro indicators are just showing a little bit of caution in advance of some of the issues we have seen so far this calendar year.
Yeah, perhaps time to move on before we go down that rabbit hole. So, David, you've been looking at the results for Octopus Renewables Infrastructure, or ORIT. What's been interesting here?
Yes, there's definitely some interesting stuff for sure, especially considering the changing conditions in the year regarding energy prices. Although the majority of ORIT's revenues are fixed, so the impact here will likely be modest at best. That said, the key points of interest include the dividend, which was raised in line with target, matching CPI growth for the fourth consecutive year. It was also well covered by operating cash flows. The forecast dividend is also expected to increase moderately, meaning that the trust now yields around 10 to 11%. Now, gearing was also reduced by £56 million in absolute terms, which marks good ongoing progress to delever, with a large majority of debt fixed at a competitive 3.3%. They continued to dispose of assets as well, allowing for a good execution of the share buyback strategy, although the trust continues to trade at a wide discount to NAV of around 44% as at the time of recording. Now, all of this continues the ORIT 2030 strategy, which has 4 priorities to hit by the end of the decade, which you can read all about in the latest piece on the website.
So sort of moderate set of results, but not a huge amount to be concerned over, although in the context of a period where we might get some push for sort of more energy secure policy domestically, a trust yielding in the double digits at a 40 plus discount looks pretty intriguing.
Quite possibly, yeah, and it really falls into your taste for mispriced yield. Now, moving on to our final results piece. Joe, you have a double dose of BlackRock World Mining this month. So firstly, could you just tell us about their results?
Yes, I can, especially considering the outstanding 74% NAV total return achieved in the 2025 financial year. And that was largely driven by the strong performance, obviously, of gold and silver miners, but copper prices also helped. They rose due to the ongoing energy transition, as well as the rollout of data centres.
So definitely a story that we've heard before, but still a pretty remarkable 1-year return profile there. What has all of that done to BRWM's income?
Well, revenues were up around 5% on the year prior, allowing for a 4% increase in the dividend. Although considering the strong NAV performance, this has resulted in a little bit of yield compression that's down to about 2.5% at the time of recording. The managers also sold their BHP royalty at the end of the year. That could potentially be a drag on future revenue growth, although there is also good potential for the higher commodity prices to feed through to better dividends later in the year.
So some interesting figures there, but to add a bit of sort of colour and context to those, you happen to speak to Olivia Markham, who is one of the managers of BRWM this month, discussing all things metal. So maybe you can sort of segue nicely and run through your chat, perhaps gold seeming like quite an obvious place to start.
Absolutely. As we know, it's clocked up more than 90 record highs since the start of 2024. It peaked not far off $5,600 in late January. In terms of the key drivers behind the rally, Olivia highlighted the currency aversion trade. So markets, as we know, are pricing in ballooning government deficits around the world. They're stocking up on gold as an alternative currency. And we've also seen central banks continue to move away from the dollar into gold, partly with the ever-present threat of sanctions in mind, as well as strong demand from retail investors who've been looking for diversification.
The gold price has dipped in the last month, which perhaps wasn't the textbook we were expecting. What were Olivia's thoughts on that?
Yeah, as you said, as a safe haven asset, you'd really have expected gold to rise with the Iran war. Actually, it's come off by around 20% to settle closer to $4,500. I think Olivia overall was pretty sanguine on this. Gold selling off after a major geopolitical event isn't out of line with what we've seen post-Ukraine, post-COVID, post-Liberation Day. Olivia pretty much put it down to investors going into full risk-off mode and wanting cash. And, gold is an obvious candidate for profit-taking after the run it's had. But historically, we have seen quite a strong recovery thereafter, and Olivia pointed to all the knock-on effects on funding, so defence spending, energy independence, as to reasons why the longer-term drivers still remain very much intact.
And what about copper, which is often described as the new oil, but prices haven't always reflected that?
Yeah, I think Olivia made a really compelling case for the outlook for copper. The demand side is all about electrification, so grids, EVs, data centres. She sees that thematic running for many years yet. Last year, the copper price was up close to about 40%. Some copper equities doubled, and supply was a key driver here. So assets are aging, grades are declining, miners are starting to have to go to trickier jurisdictions. And that dynamic of rising demand and constrained supply should be a long-term positive for the copper price.
And we know the investment world loves a good acronym, and the newest one that I've heard is the HALO trade, which for the uninitiated stands for Hard Assets Low Obsolescence Risk. Does Olivia foresee a genuine rotation from US tech into commodities?
Yeah, I think Olivia was pretty excited about this one. Her argument was around AI disrupting CapEx-like businesses like software. Obviously, AI can't build a copper mine, it can't replace a power grid. And she pointed out that mining used to have a bigger index weighting than technology, with all the physical materials we need for defence spending, onshoring, the data centre build out. She thinks we could be at the beginning of a meaningful rotation back into commodities.
Interesting. Now, moving on, David, you welcomed Ashoka India Equities Ayush Abhijit back onto the Trust Issues podcast. Very interesting timing, considering sort of the run that India's been on. So what's his verdict on what has been sort of one of the worst performing markets over the past 18 months?
Yeah, now India really kind of missed out on the emerging market renaissance we've seen over the past couple of years. So it was really good to get an update from Ayush. He certainly painted it as being a case of profits being taken. While the MSCI India IMI index has lost a quarter of its US dollar value since September 2024, it had risen by 130% in the 5 years before that. So very sensible, I think, profit taking there. That said, another cause seems to have been disappointing earnings growth in the Indian market, which is generally something that investors have been able to bank on. Long-term earnings growth had been somewhere in the ballpark of 12% a year over the past 30 years. Now that's fallen to kind of mid to high single digits for the past 12 to 18 months.
So tough times for Indian businesses then?
Yes, but there are certainly some positives to take away. India has a real investment culture, with retail investors having diversified their wealth away from gold and real estate and into stocks. They plough about $3 billion per month or $36 billion per year into mutual funds through systematic investment plans. Another positive is the IPO market. Normally, as we've kind of seen in the West, when stock markets go through a tricky phase, private companies that had been considering floating on the stock market in the good times tend to kind of retrench and change their plans, delaying their IPO until things are looking up again. This really hasn't been the case in India. According to EY, there were 367 IPOs in India in 2025, raising $23 billion, which is a huge amount. Now, this is good for AIE because the trust can invest in pre-IPO opportunities. That's an area that's driven plenty of alpha since the trust launched. Now, rounding things off, Ayush recalled that the two best times to have bought the Indian market in the past 6 years or so were at the depths of the COVID crisis and when the Russia-Ukraine war broke out. It's possible that the third best time could be at the depths of the Iran conflict now.
So with all of that in mind, David, and seeing as we've touched on India quite a few times, let's perhaps turn the tables on you. What are your thoughts on investing in India right now?
Yes, I've definitely been adding exposure over maybe the last kind of year or so, started around the start of kind of 2025. It's a really good story, I think, India. It's got really attractive demographics. It's got a emerging middle class, and obviously it's a very entrepreneurial country, population. Now, clearly it was very pricey, and, it was probably that was the reason why I was kind of holding off. I don't have too much in the US because it's quite expensive. So why would I do the same in India? Now, that's less so the case now. It was one of the very few stock markets last year that wasn't hitting record highs. So I think as I was kind of looking for interesting value, I think that definitely piqued my choice. AIE has been my choice in India. It does at the moment kind of feel like catching a falling knife. But I'm hoping that, it's kind of building a base for future. And I think it's, one of the really kind of interesting investment stories around the world, I think. So yeah, that's my views on it. Joe, do you have any kind of exposure or views on India?
I do have a little bit of exposure via Jupiter India, which I've owned for a while. I mean, I think I probably first started investing in maybe 5 years ago, so it's kind of gone up and then back down again. One of the benefits of doing podcasts as we do with fund managers is you hear from the horse's mouth. And I think one thing that very much came through with the Asian fund managers last year was that valuations continue to look stretched in India. So I've taken more of a broad brush approach. I've got Schroder Oriental Income. I've got BlackRock Frontiers at the smaller end. They both had a really good 2025, but I'm leaving it to the experts to decide on the countries to invest in rather than going for single country exposure. So Ryan, how about you?
Yeah, I think just sort of touching on your Schroder's point, like Oriental Income has recently added an amount to India, even though it's off benchmark, it's not in their index, and yet they've seen valuations. So for an income investor to spot that is quite interesting. I think my views on the India story more generally is that it's been quite an odd market. Like it fell sort of roughly at the same time as China picked up, and people sort of called it the India versus China trade around September 24, where those firms missed those earnings expectations. And then after about 6 months, we thought it was played out, but then it just seems to have been, it got hit by tariffs, and then there was a real delayed tariff effect that sort of caught the market, which was quite surprising because India thought it would be all right, then got caught in this sort of second wave of things when Trump got upset about buying Russian oil, and then it got caught up in the AI sell-off related to software. And you think a huge part of that Indian economy is related to sort of software and IT servicing businesses. So, but with all that in mind, I mean, the structural story, like you said, David, hasn't changed. Like demographics are not going to get wiped out by a 6-month technology-related sell-off. All the government spending is not going to get affected by the temporary oil price issues. So there's still an awful lot to like of the Indian market. And while valuations have come down, they are still pretty high relative to historic valuations. So whilst I'm not quite brave enough to dip my toe into the market yet and do that, I think the way to do it is through active management. It's one of those markets where you go, well, actually active management really does make a difference. Like you were saying in your piece about the IPO market, there are so many new companies coming to market. It's such a deep market with such little research penetration that active managers are the ones to do that. So the likes of AIE, ANII, the JII as well, which is now JIGI. But yeah, there are lots of really good active managers focused on the space. I think that's the way to go about capitalizing on that market. Now, moving on from our India story, Joe, it's your turn to sort of close us off with the stat of the month. So what has caught your eye in March?
Yeah, this month I have picked the latest Bank of America Global Fund Manager Survey. So it's a bit of a mouthful. Because it revealed a record rotation out of US equities. So allocations dropped 40 percentage points to a net 23% underweight in March. And digging down beneath the headline number, I think nearly 70% of those managers believe that US exceptionalism narrative has now peaked. Obviously, overall sentiment has also deteriorated amid all the geopolitical issues, also potentially the risk of stagflation. And this kind of falling sentiment has prompted a clear rotation away from cyclical assets, so more towards defensive, such as consumer staples and healthcare. Cash allocations have interestingly jumped up too. Interesting commodities in Japan has also picked up. So I think all in all, a much more cautious set of allocations. It'll be really interesting to see whether that continues next month or whether perhaps sentiment starts to pick up again.
Absolutely. And on that note, thanks for joining us for the monthly roundup brought to you in association with Schroders. For more investment trust news, insights, and updates, head over to the Kepler Trust Intelligence website, and we hope to see you again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.